Monday, March 13th, 2023, Maneco 64, home of alternative economics and contrarian views. So there are a lot of those out there, of course, who benefit from the system not collapsing, that are saying this is not a bailout, that this is just an intervention. Taxpayers are not paying for anything. But I beg to differ. I mean, there's an old saying that goes like this: if it looks like a duck, swims like a duck, and quacks like a duck, then it probably is a duck. So if it smells like a bailout of depositors that had more than $250,000, then yeah, I think it is a bailout. Yes, they didn't bail out the bank, but they effectively bailed out the 0.1% and probably the 1%ers as well. That's what Janet Yellen did, and that's what we're going to look at. So yes, it's very easy to get angry. I mean, we've been bailing out people like the 0.01% for about 15 years now. It started in 2008, and also we saw it in 2020, and again now. But I think the thing to do is to not get angry, because it's not a very good emotion, but get even. How do you get even? Well, you keep exposing them with the truth. The other thing as well, in order to protect yourself and your family, and this is my opinion, get your funds, because they're not money. You don't have money in these banks. We've seen in the last few days that it's just like mythical values, just like Vladimir Putin, president of Russia, said last year. They are all mythical values. The only thing that is real in terms of money is gold and silver outside the system. So I will try to keep stacking as much as possible. Am I telling you to do the same thing? No, but that's what I'm going to keep doing. That's what I wanted to say. And that's why I wanted to give a shout out to my partners in North America and also here in the UK, who I've known for many years, and that I trust, and especially in these turbulent times. So if you're interested, check below in the description of this video for the details of how to get in touch with them. So Janet Yellen, she's the Secretary of the Treasury. She's in charge of the purse for the United States Treasury. And then you have, of course, the Federal Reserve. She worked at the Federal Reserve. She took over after Bernanke retired. And before she became Secretary of the Treasury under the new administration, well, she made a lot of speeches, and she made, I think, about $8 million speaking mainly to Wall Street firms, banks, hedge funds. And this is not partisan, because I think this would have happened with any administration in power. They would have come to the rescue. They always do. George Bush came to the rescue in 2008, 2009. Then Obama kept the rescue. It doesn't really matter who's in power. So this is not partisan, as I said. So even CNN reported it. Janet Yellen made millions giving speeches to Wall Street banks. She'll soon regulate. There you go. And we've got also The Hill. Yellen, Blinken made more than $1 million from corporate speeches, clients' financial disclosures. So it says here in the Hill article, Yellen, whom progressives praised when Biden named her as the Treasury nominee, made millions in speaking fees from Citigroup, Goldman Sachs, Google, City National Bank, UBS, Citadel, LLC, Barclays, Credit Suisse, Salesforce, and others. I couldn't find if she spoke to Pershing Square. And what is Pershing Square? Well, it's a hedge fund owned by Bill Ackman, who's been very vocal that the Fed and the Treasury have to intervene. He's one of those 0.01%ers. So I would say Cyprus follows more the rule of law than the United States. And why is that? Well, because when Cyprus had their banking crisis in 2013, yes, they covered the depositors up to 100,000 euros, but all those who had above 100,000, they lost. They lost all their money. Yes, they got shares in banks that weren't really too solvent. That's how it worked. They swapped the cash for equity. But in the United States now, there is no rule of law. West now then, unlike Cyprus, the government and you really, in the end of the day, you're going to be paying for it through inflation and through higher fees, because the banks are going to have to pay more into the FDIC. And how are they going to do that? Well, by charging more for stuff, because the FDIC only insures deposits up to $250,000. And 97% of the depositors at SVB Bank had over 250,000. And I sent an email to John Titus last night. It would be good to have him on. Hopefully, I'll be able to get him on soon to speak about that. And talking about this, I said, you were right on the money with your analysis, and it took less than a month after your video for the system to start unraveling. He forecast this because he looked at the FDIC data, and this was back in the beginning of February. And I said to him, I'm seeing that many are saying that the Treasury and Fed are not bailing out the depositors with more than $250,000. To me, it looks like a bailout, as a lot of tech millionaires are being made whole. What's your take on this? So this is what he replied to me, and thank you, John, for replying. There is no way accounts north of 250,000 don't get bailed out. Why? One paragraph. There are 125 million households, so that figure tells you that the average household in the top 0.01% has north of $5 million sitting in the bank. Do you think each household has 20 separate accounts, so each one is below 250,000? I don't. In fact, if you look at the latest statistics at a glance, you'll find that only 10 trillion out of the 17.7 trillion deposit base is insured. I'll bet most of the uninsured deposits are coming from the top 0.1% and top 1%. And why do they have so much in the bank now? Why? The spike on that Fred graph above. Because those households profited from pandemic QE, either through direct asset sales or indirectly through companies those households own or operate. And he says, plus the Fed is shitting its pants right now. If they don't bail out the 0.1% in their huge bank accounts, things could get real ugly real fast. You're going to hear a lot of experts out there on Wall Street, probably on CNBC, Bloomberg, and all the business channels, which I don't watch, but I have an idea of what they're saying because I follow a lot of stuff on Twitter. They're going to be saying this is not a bailout. Technically, it's not a bailout of the bank, but it is a bailout of the 0.1 and the 1%ers. That's for sure. And as I said earlier, I think this is far from over. Even Bill Ackman of Pershing Square, who's been a cheerleader for this bailout, he's saying that things are not done yet, that it could get worse. And we've also seen Goldman Sachs. They've come out and they said they expect no FOMC rate hike next week. So there you go. Of course, I think, this is the big accident, the big mistake. Of course, the Fed pushed and pushed. They had to raise rates, of course, because prices were getting out of control. The consequence of the inflation they created from 2020 to 2022. Yes, the inflation was created. It started out during the Trump administration. The result that we're seeing, higher prices, was caused by that. And I'm not absolving, of course, the Biden administration for anything, because they actually have been pumping up the fiscal spending as well. So, yeah, it's 8:03 a.m. London time, so we're going to look at the markets. We're only 4 hours ahead now in London because you guys have changed your time. We haven't yet. So we've got spot gold at 1875. It's up only $9, and you might think, why isn't gold higher? Why isn't above 1900? They're bailing everyone out. They're not going to cut rate. They're not going to raise rates, maybe. Hopefully by now you have realized that the quality of gold and silver outside the system is that it has no counterparty risk and that it always holds its value. It has for thousands of years. Yes, the depositors at SVB, the very wealthy, they're going to get their money this morning. If I were in their shoes, I would be taking that money out and buying real things really quickly, because I mean, they should realize now that there's no safety in these banks. This fiat currency system is not fit for purpose, of course. But anyway, yeah, the high overnight has been 1896 and the low 1867. Don't forget, gold was up like $30 or 2% on Friday. So it was already discounting some kind of intervention by the Fed and the Treasury. We've got silver at 2074. That's up 21 cents. The high has been 2098 and the low 2053. To the stock market. The Dow futures is up 0.8% or 275 points. The NASDAQ 100 future is up 1.4%. S&P 500 is up 1.3 at 39.11. Just before I go further, some of you in the UK might be asking, what about the UK banks? Well, all these banks are they're run the same way. None of them are safe, really. I saw that HSBC is going to be taking over the SVB Bank UK. And it was probably with the backing of the Bank of England. They've just used HSBC as a front. So Bank of England bailing out another bank as well. So we'll go to the currencies now. Yes, the dollar has dropped here. The pound is up just over 0.5%, 121.02. The euro is up 0.8 at 107.25. And the dollar is down 1/3% versus the yen at 134.55. And the dollar is down 0.5% versus the yuan at 690.50. Aussie dollar is up 1.3% at 66.70. The dollar is down 0.2% versus the Canadian dollar, 137.35. And the Kiwi dollar is up 0.7% at 61.86. Let's look at the general commodities. We're going to look at platinum first. Platinum looks like it's pretty much unchanged at 965. WTI crude is up 1/3 at 76.92. Brent crude is up 0.2 at 86. Brent crude is up 0.2% at 82.70. And high-grade copper is up 1/3% at 404. So let's quickly look at the Treasury market, which has been a source of all the troubles, really, in the banking sector, because a lot of these banks have been buying treasuries and mortgage-backed securities because they've been told by the regulators that they're risk-free investments, right? And some people have said, oh, the people at SVB, they've done a really bad job. They bought all these securities. Well, they've just done what the Fed has been doing as well, which is buy treasuries and mortgage-backed securities. And Clive Thompson, who I had on last night with Rafi Faber for the live stream, he's calculated that the Fed is sitting on more than $1 trillion of losses. So there you go. They're leading by example. So the 10-year yield is at 370. Yes, it dropped quite a bit last week at the end of the week. But interestingly, we've got the 2-year down about 12 at 446. And that's quite significant that it's back below 4.5. It shows that the markets are probably expecting the Fed to really pause and not hike anymore. And we saw Goldman Sachs also talk about that. So, and the 4-month Treasury bill apparently is down 11 basis points. So we'll have to wait and see till the 21st of March to see whether the Fed hikes rates. I think Goldman Sachs might be right about them pausing the rate hikes. So with that, I'm going to wish you all a very good day. Take care. Bye.